Welcome to Module 6. Now we give a rest to valuation and risk and return and focus on one of the most important issues in corporate finance, how to make capital investment decisions. In this module, we developed the idea of capital budgeting, also called project evaluation. These are the investment decisions of the firm. We focus on what is a project and how we should define the returns a firm earns from a project. These are the techniques available to help managers make the right investment decision, and in this module we will learn how to calculate each of them and assess their strengths and weaknesses. As usual, we start with a real-life example. PMI Gold Corporation, an Australian resource company who is listed on the Australian, Toronto and Frankfurt stock exchanges, fully owns this project in Ghana, which according to a feasibility study could produce over 200,000 ounces of gold per year over the expected 11.2 years of mine life. PMI Gold's investment in Ghana project had an estimated net present value of 680.5 million. It was expected to produce a pre-tax internal rate of return of more than 42%, and it had a 2.9-year payback period after gold production begins. Despite flat trading in the shares following its merger of equals announcements with Keegan Resources Inc., in December 2012, Canadian investors reacted positively to the report. We observed that these announcements have a positive effect on the company as it shows the potential for value creation for the company from this project and positive future earnings. Capital budgeting is making decisions about what investments the firm should take, what assets to buy, and so on. This is a fundamental area of corporate finance. It covers investment decisions ranging from purchasing a small asset such as a piece of machinery, undertaking a major project such as construction of a new production facility, to even a merger with another company. Capital projects, which make up the long-term asset portion of the balance sheet, are so large sometimes they ultimately decide the future of the company. Almost every decision made by management regarding the assets of the firm can be framed as an investment and evaluated using the techniques we present in this module. Every time an investment or project is evaluated, the aim is to find out which one creates more value for the firm. Remember, the ultimate goal of the financial manager is to maximize shareholders' wealth by maximizing the value of the firm. In general, when evaluating investments and projects, these are the basic principles that need to be followed. Analysis is based on cash flows, not accounting earnings. Accounting earnings include non-cash items that must be excluded, while intangibles and other non-cash benefits must be included as they may be reflected in future cash flows. To get from accounting earnings to cash flows, you have to add back non-cash expenses like depreciation, subtract out cash outflows that are not expensed, such as capital expenditures, turn accrual revenues and expenses into cash revenues and expenses by considering changes in working capital. Timing of cash flows is crucial. The time value of money has a dramatic impact on real cash flows due to the discounting process. Only incremental cash flows are included in the analysis. For example, when analyzing a project, sunk costs should not be considered as they are not incremental. They are in the past. Managers also are interested in after-tax cash flows. Thus, taxes must be fully reflected in all capital budgeting decisions. Financing costs are ignored because they are reflected in the required rate of return. Now, when evaluating projects based on each of those listed techniques at the beginning, we must keep in mind, is there an adjustment for time value of money? Is the technique considering the fact that cash flows are spread out throughout the life of the project? Is there any adjustment for risk in this technique? And the most important question, does the decision provide information on whether we are creating value for the firm? This table shows that, in general, the most used capital budgeting techniques by managers are the internal rate of return and net present value, followed by payback, discounted payback, and accounting rate of return, with profitability index ranking last. To show how these capital budgeting techniques work, we will follow the example of Global Untethered, GU, a worldwide provider of wireless devices. GU is contemplating a major expansion of its wireless network in 2 different regions, in Western Europe, and a smaller investment in southeastern Australia to establish a toehold. Each of these projects has its own cash flows, with the European expansion project being the bigger project, requiring an initial investment of 250 million, and the Australian project being much smaller, requiring an initial investment of only 50 million. Both projects will generate cash flows for 5 years. The firm uses a discount rate or required rate of return of 18%. Recall from the valuation module we said that we consider the value of an asset, for example a share, to be given by the present value of the cash flows it can produce, the dividends. Therefore, the evaluation of investment proposals should involve comparing the present value of a project's cash flows, the income we get from it, with its cost, what we pay for it. The difference between the present value of a project and its cost is called the net present value. And this is the first technique that allows us to evaluate an investment. The decision rule is to accept if a project's NPV is greater than 0 and reject if the NPV is less than 0. Remember, we said we should always ask 3 important questions when using a technique in capital budgeting decisions. Does the NPV account for the time value of money? Does it account for the risk of the cash flows? Does it provide an indication whether the project adds value? The answer to all these questions is yes. NPV takes in consideration all future cash flows and is using the discounting process. By discounting these cash flows at the rates of return, the firm is incorporating the minimum acceptable rate of return on the firm's projects. Thus, it takes in consideration the risk of the project. Because we offset the present value of cash flow with the initial cost, NPV determines the incremental value created by the project. We know exactly how much value the project creates. Consequently, only positive NPV investments will increase shareholders' wealth. If the required rate of return is the return shareholders expect the company to earn on the investment proposal, and the company accepts a project with positive NPV, then taking that project will increase the present value of the company and therefore shareholders' wealth. Applying NPV to our example, we see that both projects have positive net present values, therefore the company should invest in both. This is the timeline of the cash flows and the discounted cash flows, which when added together are greater than the initial cost. What are the pros and cons of NPV? NPV is considered the best capital budgeting technique to evaluate projects for the reasons we mentioned earlier. It focuses on cash flows, not accounting income. It adjusts for time value of money and risk by discounting all the cash flows at the firm's required rate of return. The only drawback of NPV is that it doesn't allow for managerial flexibility when evaluating projects. NPV is considered a static discounting cash flow method and does not account for real options, the ability to expand the project, for example, after it has been accepted, or the option to abandon it if it doesn't earn as expected, or the option to postpone a project to a later starting date. Also, the NPV result comes in dollar values, and sometimes it's hard to compare projects just by looking at the NPV result if you don't know the initial cost. The next method is the internal rate of return. The internal rate of return for an investment proposal is the discount rate that equates the present value of the expected cash flows with the initial cash flow. Thus, the IRR is the interest rate that discounts the future cash flows to equal in present value term to the initial cash flow at time 0. Basically, it's the rate that makes the NPV equal to 0. The general acceptance criteria for the internal rate of return method is to compare the calculated internal rate of return to a rate which we call it hurdle rate. We call this the basic IRR rule. If the IRR is greater than the hurdle rate, the project will add to the shareholders' wealth and it exceeds the rate which would be required to maintain the shareholder value. Conversely, if IRR is less than the hurdle rate, the project is rejected. Note that this hurdle rate is the same as the cost of capital, the required rate of return, or the discount rate that we use in the NPV technique. Applying this technique to our example, we see that both projects have an IRR greater than the hurdle rate of 18%, the discount rate originally set up by the company. Manually, we would calculate IRR by trial and error. However, Excel has IRR function which makes things easier. Both projects earn a rate of return which is above what is required. Therefore, they are both acceptable. If we draw the NPV profiles, which are the project's NPVs at various discount rates, we see that the NPV is 0 at exactly the IRRs calculated of 28% and 37%. Both are above the required rate of return of 18%, because at 18% we see that both have positive NPVs of $25.7 and $75.3. This is the graphical representation of the IRR calculations for the two projects. Basically, we need to find out the discount rate that will make the sum of discounted projects' cash flows equal exactly to the initial cost. Basically, find the discount rate that makes the NPV equal to 0. Note that there is a relationship between net present value and internal rate of return. Both techniques will generally give the same decision to accept or reject the project if the cash flows are conventional. If NPV is positive, then we know the project will have an internal rate of return greater than the hurdle rate. Similar, if NPV is negative, then we know for sure the internal rate of return is less than the hurdle rate. So the internal rate of return gives us the break-even rate of return. At this rate, our project breaks even. Its NPV is equal to 0. The advantage of using the internal rate of return technique is that it accounts for the time value. IRR is also called the discounted cash flow return. Furthermore, like the NPV, it uses cash flows, not some accounting measure, and accounts for all cash flows. The internal rate of return accounts for the risk of the cash flows because you compare the IRR to the required return, which is determined by the risk of the project. The IRR rule provides an indication of value because we will always increase value of the firm if the project earns a return greater than what our required return. So the IRR technique is the most important alternative to the NPV technique. Management and individuals in general often have a much better feel for percentage returns and the value that is created than they do for dollar increases. However, the disadvantage of internal rate of return is that it can give the wrong decision when the project has non-conventional cash flows. Then we have the lending versus borrowing problem and multiple IRRs, and also when projects are mutually exclusive, because IRR is scale biased and doesn't take in consideration the timing of cash flows. In the next section, we will look at those problems with the IRR.